Okay, just a quick disclaimer. I want to make a commentary based upon my old economic report from almost 3 years ago now on my forecast for rates to go higher. And just to clarify, there's upward pressure that's on rates. That doesn't necessarily mean they're going to move in that direction. And the reason why they didn't move in that direction, although there was a push for about 6 months thereafter that forecast, that rates wound up moving higher and higher and higher in 3 moves and then started to downtrend again. So the reason for that is because the rest of the world continues to print money, and now even the US central banks printing money with the repo operation. That's a clear evidence actually that my forecast has proven correct, but the rates in general, in terms of the upward pressures, the rates in general are going to be continually dragged down lower because the central banks outside of the US are continually printing, and it's causing negative rates to go, the phenomenon to occur. So when the phenomenon occurs, it drags the rates of all the other currencies in the world lower because of something called the carry trade. So that's what's been occurring, and it will continue to occur. Rates are going to continue to go lower for a little while, until you reach the only situation where rates at this point will go higher is an emergency scenario, a panic, some kind of wild sell-off or market disruption, which we're kind of seeing with the corona, but this not anywhere near severe enough to cause what I'm talking about in this particular instance. So the corona is a concern, sure, but it's not a huge deal. It's really not. It's a little bit more than a blip on my radar, but and will have fairly dramatic effects in the short term for sure. In the medium term, there will be effects. It's going to drag the economy down. But apart from all that, you got to be prepared. It's you either prepared for you live a lifestyle or you don't. It's not a matter. If you're getting here now to the game, it's probably too late for you to make huge changes. But you can make a change. But it's not like we're talking about the end of times here. But I'm just talking about in terms of position. You always want to position yourself in the best of ways. I preach diversification. I preach having a portion of your overall portfolio in silver and gold. We're seeing the big pressures on that now. I think we may see probably, I'm going to call a 3 to 5-fold move on gold and a 5-fold, I'm going to say probably 4 to 10-fold move on silver over the next 10 to 20 years, maybe a lot sooner. So that's what I'm looking at there. The stock market, you can't beat the stock market in the long run. There's nothing wrong with it, and an opportunity like is going on today or this week down 200 points, pretty wild. And then you have hell, I think we were down 1,200 points today on the Dow, the most severe drop ever. So I suppose it's appropriate for me to come out now and speak some words on the markets with relevance to economics. So I would be buying at a point that's probably anywhere below. Personally, I'd like to be 18% or less. I'm sorry, 18% or more on a correction. But realistically, I'd be buying in anywhere that's probably 12 to 20 plus, and 12 to whatever. I would as a general investor, if you have some money or cash on the side, I would begin segmented buying. They call it dollar cost averaging strategy over the sequence of time. And so with that, I think we're just about at 12% on the correction, so it's probably going to go down a couple more days, and then you'll see a V-shaped recovery, probably back to where we are now, and then things will stabilize for a little bit and figure out where they are, and then eventually continue higher, much higher. So that's pretty much where things are now. Oil's going to continue. I warned you about oil and played out like a bell. Markets ripping higher, yeah. Yep, they ripped higher, and now they're going to come lower. And then they're going to go higher again. Earnings haven't been that impressive. We're going through a restructuring cycle with our economy in the United States. The rest of the world is also restructuring. We're putting things back into play and into position where there's a fair aspect of trade, of global trade, and just overall in the United States specifically. And it's amazing how large of a player the United States is, and the influence that the United States has on the rest of the world. It's pretty extraordinary. When I came up with these ideas about tariffs and supporting ideas about protectionism 5-6 years ago, I didn't quite think the effects would be. I don't know. It's hard to imagine the effects. You know, you see it on paper. You study the theory, you learn it, you try to master it as best you can. But certain things you could throw right out, like the Phillips curve. So it's pretty interesting for me to see it play out. Anyway, I'll have more on the economy and where things are going. But me personally, I like real estate. I like gold, silver. I like the stock market. Take advantage of buying on the dip, and take advantage of IRA plans. They're good for a lot of reasons. Tax deferred savings, pre-tax investment income, pre-tax investment, employer matching. So there's a lot of benefits there. You can invest in what you like. It's a good thing. Helps to support and fund the markets. Real estate's good if you want to get involved in real estate, and in terms of owning a house, what have you, or investments. I'm going to be becoming more involved in real estate investing, since I'm a craftsman and a man of the trades. So anyway, much love. Peace out.